What a volatile session yesterday due to conflicting news flow surrounding from the US Iran slash war conflict. And that actually kind of gave the US Iran peace deal resolution talks in jeopardy, where both sides continues to play a game of poker. And that led to a plunge earlier in the West Texas crude oil plunging about 4%, hitting the $90 per barrel. And due to elevated risk of stagflation, potentially rising bets in interest rate hikes by the Fed causes gold to plunge by close to 1.2% yesterday, breaching below the 4,500 psychological per ounce level. And right now, gold is actually testing a key 200-day moving average with fragile technical conditions. Earlier in the US session, the Nasdaq 100, which is the major uh, catalyst in this ongoing risk on movement in the global risk assets since end of March, faces an intraday sell-off at the first half of yesterday's US session after hitting a key inflection level of around 30,140, which I highlighted earlier on. And at the end of the US session, it managed to claw back some of its losses and ended almost unchanged. However, interim technical condition has started to turn bearish on the Nasdaq 100. Welcome back to another session of Daily Dose, which is going to be pretty interesting today. I'm Kelvin here. Hopefully, you guys have a restful week yesterday as it's a public holiday in Singapore. Today will be Thursday, the 28th of May, 2026. So as usual, before we jump into the gist of today's Daily Dose, let's have a quick look at the disclaimer first. Leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is for general information purposes and is not investment advice. Past information is not representative of future results. Right, so here we go. So let's have a quick recap what has taken shape in the last 24 hours and as well as in today's early Asia session. All right, so let me share with you this rather interesting slash conflicting news flow coming out from this US-Iran relationship as both of them try to play a game of poker. Right, so let me share my screen. Right, so hopefully the screen is good, yeah? All right, so this is the particular news flow over here. So basically, there was a strike by US on a Iranian military installation as Trump votes to watch over the Strait of Hormuz over here. Right. So basically, the attack by US on a particular military installation in Iran. Still recall that both sides agreed to have a ceasefire as both of them try to lay down a middle ground to allow for a at least an interim peace deal resolution. But before this peace deal resolution that was being touted to be very near on site by US White House administration senior officials last weekend and as well as on Monday, and even Trump himself stating very proudly in his public speeches that a near-term peace resolution is pretty close. But before that got officially signed off, yesterday US attacked Iran's military installation. So that causes a bit of freak out in the global risk asset space, where we start to see a sell-off on the US stock market at the start of the US session yesterday. No, in the middle of the US session yesterday. Later I'll flash you guys the movement of the intraday movement of the stock indices for a better visualization. So let us now focus on this piece of news flow first. So American forces carry out airstrikes on Iranian military site. So that actually gave a bit of question to that fragility of that ceasefire deal over here. So basically, why they decide to do an airstrike is to put pressure on Iran, stating that no one could actually control the Strait of Hormuz. So bear in mind that during the weekend where both sides try to find a middle ground, there's one particular sticking point is that the Iran side still wants to have some form in the control of Strait of Hormuz, potentially doing some kind of toll system on ships or oil tankers passing through the Strait of Hormuz over here. but US doesn't want to allow that to happen. So I do reckon that this airstrike is to put pressure on Iran to actually back down on this potential setting out a toll system in the Strait of Hormuz. And what's interesting over here is that after the airstrike was being carried out by US, Iranian official TV channel, one of them, let me highlight, was it? It was somewhere around here. Come on, give me a minute. Let me go through. Yes, this is the one. Let me highlight it over here. Okay, so basically, there's an Iranian state television report on a draft interim peace deal where the Iranian side stated that maritime traffic through the Strait of Hormuz could return to normal within a month of coming into effect. So that actually causes the oil prices to plunge yesterday about close to about 3 to 4%. Now trading below the $95 USD per barrel because of this news flow. But however, after this news flow is being released in public, the White House cast the report and the draft memorandum of the understanding as a complete fabrication, saying that nobody would believe what Iranian state media is putting out over here. So basically, both sides are trying to play a game of poker that causes intraday whipsaw movement on the global markets, right? So if you look at the US stock market performance yesterday, this was the off that took shape, all right, due to that conflicting news flow remarks over here, the conflicting, we call it situation that unfold between US and Iran. Then thereafter, at the second half of the US session, we see some clawback of the losses. All right. So by the end of the US session, both the S&P and the Nasdaq 100 closed almost unchanged. And the one that managed to inch out a slight gain was the Dow Jones Industrial Average, given the fact that they are not heavily weighted on the technology stocks and inch out a gain of 0.36% due to consumer staples and healthcare outperforming the market yesterday. The small cap Russell 2000 also hit almost the unchanged mark. But what's interesting over here is that we know that the rally in the broad-based risk asset classes, that means we're talking about the global equities, has been led by AI slash semiconductor play. So one of the benchmark indices that I could actually look at will be the US semiconductor index. All right, stocks in short over here. So the stocks yesterday ended negative 1.36%, greatly underperforming the four major benchmark US stock indices. So what we could see over here is that yesterday the leaders health were deteriorated by the conflicting news flow coming out from the US Iran sides of the story. And if you look at the heat map of the S&P 500, very clearly we see a slew of red in the semiconductor segment within the technology sector. All right, so we have Nvidia down by negative 1%, and some of the other semiconductor stocks like AMD is more than 1%, negative 1.67. Intel down by negative 1.42, and the worst Qualcomm down by negative 6.2% over here. And we see a slew of green in that sector, all right, where one of the biggest price weighted cap in the Dow Jones Industrial Average was United Healthcare, which managed to gain 1.9% yesterday. Right, energy was hit badly as well due to the plunge in oil prices yesterday. So if you look at the heat map of the 11 sector performance on the S&P 500 yesterday, very clearly more reds than green. So the only one that is performing well is the consumer cyclicals, consumer defensive, and communication services, whilst the rest of the sector closed deeply red. All right, technology down by negative 0.4% due to the lackluster performance and underperformance of the key semiconductor stocks. and the worst hit was energy, down by negative 1.84% due to the plunge in oil prices yesterday. All right, so what's interesting over here is that the plunge in oil prices also come to a increasing risk of the Fed. Yes, even though oil prices plunges yesterday, that doesn't change the expectation that has been portrayed by the Fed funds futures traders on the future monetary policy guidance under the new Fed chair Kelvin, which has officially took over the rim from Fed chair Jerome Powell. So if you look at the Fed funds CME Fed funds CME Fed funds 2 Fed Watch 2, pardon me, CME Fed Watch 2, which take into account of the latest price action behavior of the Fed funds futures traders in the Fed funds futures market. This is not live, it's about 1 to 2 hours delay. Let me refresh it again, right, to reflect it. Right. So we know that the current Fed funds rate is at 3.5% to, okay, give me a minute. It's a bit slower. Okay, let me make sure that it's good. Right. Excellent. So the current Fed funds rate is 3.5% to 3.75%. So we know that these are the meeting dates down the calendar. So if you look at then all these percentage are the odds of where the Fed funds rate will be. So if you look at by the end of this year, which is the December the 9th, 2026, the last meeting of this year, market participants in the Fed funds futures market has now increased bets of 71% chance that the Fed may ignite a 25 basis point hike, not cut, on the last meeting for this year. All right, 70%, 71% chance to bring the Fed funds rate up higher to 3.75% to 4%. And that odds continues to rise in the first half of next year. All right. So what market is looking at, market is now not pricing even a cut to come in into the later half of next year, December the 8th, 2027. All right. Still having a high chance of what 51% chance that the Fed funds rate will be at 3.75% to 4%. So that so-called earlier interest rate cut bets that was priced in the first quarter of this year has been totally evaporated, and market participants in the Fed funds futures market is now looking for the Fed to be more hawkish and dovish rather than dovish, pardon me. All right. So rather than a wait and hold and slightly dovish, now it become no longer a wait and hold, but a height followed by a wait and hold. All right, but of 25 basis point height on the potentially last meeting of this year, which is the December the 9th, 2026. So that actually causes gold prices to plunge yesterday, right? Because we know that if the US Federal Reserve starts to turn hawkish, together with other central bankers as well, like the ECB. So ECB at the start of this year, they are looking to normalize their interest rate on the higher side. That means looking for an interest rate, not an interest rate cut. That means they already cut interest rate last year. They paused for a period of time, and now they're looking to tightening interest rate, their interest rate policy in Eurozone due to stagflation risk. So net overall, with the Fed now joining into the much more hawkish circle of things, that could put pressure on gold, given that gold is a non-income yielding asset class. That means for people who buy gold and hold it, they're having a higher opportunity cost if interest rate in the near term, medium term, and even the long term starts to rise. All right. And that also that potential, what you call it, hawkish vibe, as expressed by the Fed funds futures traders shown in the CME Fed Watch 2, causes a negative feedback loop in the Asia market today. So in the Asia market today, if you look at the Nikkei 225, is almost unchanged over here as we are speaking right now, 0.06%. But however, if you look at the Hang Seng index, it actually down by negative 2% right now. All right, as we are speaking. And that also create a negative feedback loop in the China A shares market, where the broader base CSI 300 is down by negative 1.14%. All right, and the smaller China A50 benchmark down by negative 0.9%. And if you look at the other Asia Pacific benchmark stock indices, the Kospi is down by negative 1.7% after hitting a fresh all-time high yesterday. Okay, and it's a bit slower to show the chart. All right, so just bear in mind for a while ago, just bear in mind. Well, I'm not sure why the connection is a bit slow today morning. All right, it's trading the session low, and the ASX 200 is so down by negative 1% plus, trading near the session low as well. Right, give me a couple of minutes to show up, a couple of seconds to show up. Right, trading near the session low, and even our defensive straight stumps index, the XTI, also the 5,000 psychological level, down now trading at 4,995, down by negative 0.66%, also trading near the session low over here. So with this hawkish vibe coming up from the Fed funds futures market, expressing an increasing risk of a Fed rate cut height, together with other central bankers also joining the hawkish bandwagon. And potentially, we also start to see a bit of positioning adjustment ahead of today's key risk data, inflation data release, which is the PCE price index. Okay, later I'll share more about the PCE price index. So now let me now take you through the second segment of the daily dose, which I will highlight various important, interesting technical configuration over here for you guys to have a focus on for today. All right. So let me start with the 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 important global stock indices. All right, over here. So let me start with the Japan. Right, so let me highlight the Japan 225 for you guys. Okay, so on the Japan 225, previously before we went for a public holiday break yesterday, I do mention that we do have a bullish bias earlier on with the resistance at 66,190, 66,558. All right, so before that, let me remove this circle so that you guys could have a better view of the charts. Yeah. Right, good. All right, so the chart is pretty clear. All right, so what we could see is that the level indeed hit, all right, it hit this resistance level before staging that pullback yesterday. But this pullback here comes with deteriorating momentum. All right, so what do you mean by deteriorating momentum? If you were to look at the hourly RSI, it shaped a bearish divergence. All right, price action higher high, RSI lower high. And what's interesting is that there is a price breakdown below its key former parallel ascending trendline support, tested it and shaping a series of a lower high. So indicating that the prior bullish momentum that was seen early at the start of this week has now flipped to a bearish momentum instead. So with that, I will use a pivotal resistance for today at 65,665, which is pretty much close to yesterday's start of the US session, flipped to a bearish bias on the Japan 225 for a potential minor corrective pullback setback scenario. Downside trigger level will be the low that is being seen on Tuesday, managed to survive at the start of today's Asia session, will be 6,620, this level here. All right, 64,620. Okay, let me put it in writing. 64,620. All right, so 64,620 downside trigger level. A break below this level will increase the odds of this minor corrective pullback slash setback scenario to expose the former all-time high area at 63,788, 63,270. All right, which is this former minor swing high of 8th of May, swing high of 14th of May, and as well as the previous gap up that is being formed on this Monday. All right, breaking below 63,770 will deepen the minor corrective pullback towards potentially 62,510 which confluence with the rising 20-day moving average. However, if we start to see a squeeze up above 65,665, then potentially it will seek out a start of a new bullish impulsive upmove sequence. In first step, retesting the current all-time high area, 66,190, 66,558, followed by 64,047 in the first step, which is a Fibo extension level. So that's for the Japan 225, flipping to a potential minor bearish corrective pullback setback scenario for today due to deteriorating momentum condition with the pivotal resistance at 65,665. So that's for the Japan 225. Next will be the all-important Nasdaq 100. All right, so Nasdaq 100, very clearly, if you still recall that on Tuesday, we do have a bullish bias. Bullish bias hit exactly at our resistance level, 30,318. 30,425. All right, so it printed a intraday all-time high yesterday at 30,327, fitting right exactly in our inflection zone before shaping a bearish shooting star candlestick at the 8 p.m. mark Singapore time yesterday. And what's interesting over here now is that we now starts to see a bearish breakdown on the hourly RSI. Right, potentially breaking below this para ascending trendline support level. Okay, and with that, very clearly, we also start to see a bearish breakdown in price action, breaking below the lower boundary of this minor ascending channel that we drew from the low of 19th of May. And yesterday's rebound that is being seen at the second half of the US session yesterday got rejected right exactly at the lower boundary of this former minor ascending channel support. Now turns into a pullback resistance intermediate one at 30,074. So with that, I will now have a bearish bias on the Nasdaq 100 for today for a potential corrective setback scenario as well. Very similar for the Nikkei 225 or the Japan 225. I do not want to use a very tight short-term pivotal support at this bearish reaction point at 30,074 that it may whipsaw. Instead, I will use at the key inflection level, which is at 30,318, 30,425 that induces that intraday sell-off yesterday, which will be my short-term pivotal resistance area. So using 30,318, 30,425 as my short-term pivotal resistance area, flip to a intraday bearish bias on the Nasdaq 100 for a potential minor corrective pullback slash setback scenario. Downside trigger level 29,700, which is the congestion area over here that is formed on 26th of May, that confluence with the former minor swing high of 15th of May that managed to stage a bounce on 26th of May. All right, breaking below 29,700, then I would tighten the pivotal resistance downwards to the bearish reaction point that is being formed today at 30,074. Next support level to watch, 29,433. Breaking below it may see a deeper minor corrective pullback scenario, exposing the psychological level of 29,000. That also confluence with the congestion area of 20th of May and also the rising 20-day moving average. Only a bullish breakout above 30,318, 30,425 that would invalidate today's bearish bias view of that corrective pullback on the Nasdaq 100 to see the continuation of its impulsive upmove sequence towards 30,728, 30,750 in the first step, which is a bunch of Fibo extension cluster level. All right. So given the bearish technical configuration or technical condition on the intraday basis that's been seen on the Nasdaq 100 right now, I will not be so convinced to maintain my bullish bias stance on the SPX 500. So for the SPX 500, I also flip to a bearish bias. So very clearly, the SPX 500 also almost hit our pivotal, our resistance level that we expressed earlier in our bullish bias view on Tuesday, 7,570. Yesterday, intraday high was 7,560, almost 10 points away. Similar high, but what we could see now is that the RSI now shape a bearish divergence, showing a series of lower high indicating that momentum has now started to turn weak. So with this bearish divergence that's been seen on the hourly RSI, I also flip to a bearish bias stance for today for a potential minor corrective pullback setback scenario that may unfold on the SPX 500 using 7,570 as my short-term pivotal resistance level. Downside trigger level will be 7,496. Breaking below it may expose 7,455 and even 7,393 today. That confluence with the rising 20-day moving average. However, if price action don't move down as intended and starts to shape a bullish breakout above 7,570, that would invalidate the corrective pullback setback scenario for today to see the continuation of the bullish impulsive upmove sequence towards 7,627, 7,632 in the first step, which is a Fibo extension level, cluster level. And with the bearish biasness on the Nasdaq 100 and the SPX, I will now have a neutrality stance on the Dow Jones Industrial Average, which is our US Wall Street 30. So flipping to a neutrality stance today for the US Wall Street 30, 50,800 level, which was yesterday's intraday high before it traded sideways. Lower limit was yesterday's bounce off the former all-time high and short-term pivotal support level that we have previously on Tuesday. All right. So flipping to a neutrality stance on the US Wall Street 30 CFD, which represent the Dow Jones Industrial Average between 50,800 and 50,541, 50,390, which is the former all-time high area that managed to survive on a Tuesday rebound over here. Okay, so that's for the US stock indices situation. Do be cautious due to the intraday technical weakness that is being seen on the Nasdaq 100. All right, next asset class on to highlight will be the gold XAU/USD. So gold plunges below our neutrality stance. So previously, even though gold bounced, we were not convinced about this bounce to be a very strong bounce. Then we flip to a neutrality stance between 4,580 and 4,500. So after breaking below 4,500, it plunges below, and now it's actually breaking below the 200-day moving average. And this 200-day moving average is pretty key. Why? Because it managed to survive in that previous steep sell-off that takes shape from 2nd of March all the way down to 3rd of March. So this is about, 3 weeks of decline over here before it starts to bounce off in a very lackluster fashion. So indicating that gold price could remains weak in the near term after yesterday's price movement of breaking below the 4,500 level. All right. So with that, I would now flip to a bearish bias stance for today. And right now, given that price action is already breaking below the 200-day moving average, I will now have a tighten pivotal resistance level. All right, tighten it to today's Asia session high, which is at 4,446. 56, pardon me. Okay, let me do a bit of adjustment. Oops, sorry. Okay, so using a Titan short-term pivotal resistance for today, which is 4,446, today Asia session high got rejected, which is the former minor swing low of 20th of May, which is at the start of the Wednesday Asia session. So 4,456, Titan short-term pivotal resistance level, flip to a bearish bias stance on Gold XAU/USD to see further potential weakness to test the next intermediate support level at 4,320, which is 24th of March 2026 low. Breaking below it may see a further decline to expose 4,167. So 4,167 is indeed the swing low area of 23rd of March 2026 over here, where it managed to form that bullish hammer candlestick before staging that corrective rebound that got rejected by the 50-day moving average since the test on it on 17th of April. All right, over here. Only a bullish break above 4,000 4,456 will negate the bearish tone to see a test again at the psychological level at 4,500, where after yesterday you can't survive, that kickstarted the current weakness. Only a breakout above 4,500 will reverse the intraday scenario from bear to a potential corrective rebound to retest this Monday high that got rejected at 4,580, which is also confluence with the downward sloping 20-day moving average. All right. So right now, flipping to a bearish bias with a tightened short-term pivotal resistance on Gold XAU/USD at 4,456 is now breaking below its key 200-day moving average. Lastly will be the West Texas oil over here. So West Texas oil, before we went for our break, we will have a bearish bias. Bearish bias hit exactly at our support 90.50, 90.50, which is the low of 6th of May and the low of 7th of May. Technical configuration now have a bullish divergence that's being formed in yesterday's US session, and right now price action, the RSI has now shaped a bullish push up above the 50 level mark, indicating that we may now see a relief rebound in today's intraday session. So with this positive intraday technical configuration as being expressed by the bullish divergence, and thereafter a positive follow through on the hourly RSI, where price action managed to survive right exactly at our bearish bias support that we expressed previously, 90.50. Hence, for today, we will flip to a intraday bullish bias for a potential relief rebound scenario on the West Texas oil using 90.50 as the short-term pivotal support level. Three key resistance level to watch out for today: 97.40, which is very important. 97.40 is actually the bully, the rejection level that was formed on Tuesday, 11 p.m. Singapore time, that kickstarted yesterday intraday sell-off. Breaking above 97.40 will increase the odds of this relief rebound towards 100, which is the psychological level that confluence with the 50-day moving average, maximum 102.56, that also confluence with the 20-day moving average. However, if price action don't move up as intended and break below 90.50, all bets are off for this minor relief rebound scenario for West Texas oil to express further weakness towards 87.60, which is the 20th of April 2026 gap up. Breaking below it will expose the all important 7 April 11 March 2026 low at 81.94 slash 81.85 over here. All right, which was the swing low area of this and this. All right. So with that, that sum up the second segment of the daily dose. So before that, before we go, let's have a quick look at the economic calendar. What are the key data to take note of for today, other than the all important core PCE inflation data that will be out at 8:30 p.m. So let me share with you what's the situation over here. So for the core PCE price index, why this data is important? Because this is an inflationary gauge where the Fed will monitor where the US Federal Reserve will monitor to determine inflationary trend in the US. So that will be released at 8:30 p.m. Singapore time. So core PCE price index that strip out of the volatile energy and food component for on a year-on-year basis over here. So you look at the year-on-year. So on a year-on-year basis, market is expecting a slight uptick to 3.3% year on year from 3.2% year on year over here. So if it goes below, above what market is expecting, that could actually increase the odds of Fed rate cut height before 2026. And so that could also potentially create a bit of profit taking activities in the global stock market. All right, so that will be at 8:30 p.m. Singapore time. And during this period, the same time, you will see the tier 2 labor data, which is the weekly initial jobless claim releasing at the same time as well. Then that potentially will see a US Federal Reserve official speaking, Fed Williams speaking at 8:55 p.m. So market participants will be hearing, will be mentioning anything in relation to the release of the core PC price index earlier. So that will be at 8:55 p.m. Singapore time, Fed Williams speech. And that's potentially wrap up this segment. for the first half of the US session. And at the second half of the US session, which is 12 a.m. Singapore time on a Friday, 29th of May, you'll see the weekly EIA crude oil stockpile change that could potentially impact the intraday movement of the West Texas crude oil. And before we kickstart tomorrow's daily dose, at 7:30 a.m. Singapore time, we have tier 1 Japanese data coming out, which is the Tokyo Core CPI data and the Tokyo Core CPI data. So both of them are expecting to come in below 2%. All right, over here. So that could put pressure on the dollar yen as it is now heading towards 159.50, heading towards up the 160 psychological level, where previously the Japan authorities intervened in the FX market about 4 to 6 weeks ago by selling off the dollar, buying back the yen. So that will be at 7:30 a.m. Singapore time tomorrow. So with that, that wrap up today's daily dose of market insight. I wish you guys a great day ahead. And given the volatile situation in the marketplace right now, as market continues to strike a balance between uncertainty between US and Iran, and as well as a Fed and other global central bankers are now turning more into the hawkish vibe of things. So with that, risk management will be pretty much paramount in such a scenario. So do have a great day ahead, and we shall speak again tomorrow. Thank you.